Good morning from Washington, D.C. And wherever you are, we appreciate you being here today and calling into our exciting webinar. We have a very important topic to discuss today. We have very unique experts will share their thoughts and information on our topic and our subject. So we hope every one of you will be on and willing to ask any questions, and I will be asking these questions at the end. It's Mohammed Barakat from the US-Qatar Business Council, Managing Director based here in Washington, D.C. I'm very glad to have very distinguished guests with us today from DLA Piper, our partner in this webinar. We're hosting to discuss financial transactions within Sharia law. The three expert attorneys with me today will highlight a lot of the important ideas when it comes to Sharia compliance and Sharia law in conducting business, financial transactions, investments, and so on. We're hopefully looking to learn on how these laws and when it comes to Sharia compliance apply if your client or the people that you work with require you to work with them, or if you are operating in countries that require Sharia law and Sharia financing and compliance with these laws. Many countries, including Qatar, use Sharia law in some transactions to conduct business. A lot of these requirements could be complicated in many cases for countries, especially from overseas where they're not familiar with it. And experts like DLA Piper and these attorneys have the knowledge and the expertise in addressing these issues. And we're very glad that they allow us to have them today in this webinar and partner with us in this webinar to highlight these matters. So I'm going to start by introducing some our guest speakers today, the attorneys. I'll start by highlighting Ehab Elsonbaty. He is based in DLA New York office. He's the head of the firm Middle Eastern Initiative. We as well have Lauren Rico and Gerald Shepard, members of the firm Real Estate Group based in Washington, D.C. and New York respectively, and worked on a number of investment transactions for Middle Eastern investors and transaction involving Sharia compliance structure. These experts have done many projects that required compliance with Sharia law with its own different aspects. Either it's investment, real estate, or in many cases, it could be even operation in the host countries that require these laws. They're been involved with high-level partners, high-level investors, so they can give you the full picture of these transactions. Before I move into our guests, I just want to highlight a few things from our perspective here at the US-Qatar Business Council. We are an organization that works to enhance and advance the business relationship between the United States and Qatar. We work closely with American companies to help them conduct business and get opportunities in the Qatari market. We work with many entities, including law firms like DLA Piper, in making sure these entities and these companies or investors are compliant with the laws and as well be able to access the opportunities that they require. Even though not all transactions in Qatar requires to be Sharia compliant, however, because it's the main part and Islamic law is the laws in a lot of this business transactions in Qatar, it is critical to address them when we work with your clients. Ehab, I want to start with you, if you don't mind, giving us a little bit overview on DLA Piper and DLA Piper practice when it comes to as well Middle East transactions with Sharia law.
Thank you very much, Mohammed, and the US-Qatar Business Council, a reliable partner to do business and to build very strong bridges between the US and Qatar to host us and to cooperate with us in this important event. We are seeing, Mohammed, lots of traction for in three buckets in general. Like DLA Piper is the third largest law firm in the world. Our Middle East initiative here in the US is the largest team in the Americas, providing our legal support to all our clients from the Middle East. And we cover all the legal needs in every area of practice. And in any jurisdictions in the Americas, we help also our Middle Eastern clients who are based here in the US or Canada or Latin America. And we do the same for the US businesses when they do business in Qatar or other GCC countries or in the Middle East in general. We have amazing capabilities with bilingual expertise and Sharia understanding. And we found by practice that there is a lot of interest of US entities, and I'm sure, Mohammed, you and the team are receiving a lot of clarifications on daily basis from US businesses, fundraisers, fund investments, biotech, healthcare. Many entities are interested in going and doing business in the Middle East. And in many cases, their partners are interested of doing the business in accordance with the Sharia principles. We help them a lot in integrating in the systems there, doing business in the right manner, and we facilitate their endeavors and their venture with their counterparties in a manner that is compliant with the Sharia, being real estate or fund investment or the likes. There is also another volume of businesses coming from the Middle East to the US, and many of them would like to do their transactions in a compliant manner with the Sharia. For instance, we represent many of the major Islamic banks in the Middle East, and all their deals that, with the support of our partners, Gerald and Lauren, are Sharia compliant, and we have successfully done fantastic deals for them, being real estate, either residential or commercial or mixed use, and we will speak a little bit further about that. And there is a very interesting bucket, Mohammed, that we have seen in the market. Those Middle Eastern-based businesses that are very well established in the US, but yet they want to do their transactions in a manner that suits their set of morals and set of principles. And they were very comfortable to seek our support and our partnership with them to do their transactions in a manner that suits their expectations and morals and so on. And we have done for them a lot of portfolio work that helps them achieve the return of investment that they are looking at in a manner that also is compliant with their desire to be compliant with their Sharia principles. You're mute, Mohammed.
I was saying, thank you, Ehab. I appreciate this highlights. It seems very interesting, and it provides a lot of information and some picture. Let me maybe ask to, if you don't mind, in expanding on the Sharia compliance or Sharia law principles. How does the Sharia compliance laws apply to these financial transactions in trade? Who's actually responsible in making sure that these transactions are Sharia compliant, and how is that structured? Do you mind giving us you or Lauren or Gerald an overview on that?
Sure, I can jump in on that. Oh, sorry, go ahead.
No, please. Like just generally speaking, and then we'll hand it over to Lauren. The idea is, of course, in Sharia law, there is no one size fits all. There are sets of requirements defined depending on the applicable laws and regulations from a perspective, and from another perspective, the Sharia board requirement in every investment organization, if it is an organization or a bank, or the set of principles for the investor if it is a family office and so on. But Lauren, maybe you can give like more highlights about the main principles that any Sharia transaction will have to consider and to respect.
Sure. Good morning, everyone. My name is Lauren Rico. I'll give 30 seconds of my specific background because Gerald and I do real estate law. So I'll tell you what I do, and then we can talk about, we'll get to how these Sharia transactions are involved in our everyday practice. So I'm a partner in the real estate group at DLA, located in Washington, D.C., as Mohammed said. I focus a significant portion of my practice on real estate finance, representing borrowers and lenders, especially in construction financing and multi-state portfolio matters. Due to my geographic location in DC, I also serve specifically as DC, Virginia, Maryland real estate counsel on transactions with a particular expertise as local real estate counsel in Virginia. So my experience with Sharia compliant transactions has been in representing real estate mortgage borrowers who have Sharia compliant investors in their ownership structures. So this requires special mortgage lender accommodations with respect to the loan documentation in order for the borrower to obtain the mortgage loan. So we'll discuss the most common structures a little bit later in this presentation, but to back up to the general principles of Sharia compliant businesses, Sharia compliant businesses operate in compliance with Sharia law. To be considered compliant, businesses need to observe the basic tenets of Islam, such as not engaging in interest-based transactions, for example, for our purposes, mortgage loans, or alcohol production, for example. Businesses must adhere to specific Sharia principles relating to contracts, property rights, and other aspects of commerce. Generally speaking, two principles are foundational to Sharia compliant business. One, material finality of the transaction. In Sharia law, every transaction needs to be related to an actual and real underlying economic transaction. And two, profit and loss sharing. Every party to a contract shares the profit, the loss, and any risks associated with the transaction. All parties must benefit equally from the transaction. And Gerald, do you want to take a deeper dive into Islamic finance?
Sure. My name is Gerald Shepard. I'm located here in the New York office of DLA Piper. My practice is also real estate focused, a lot of acquisitions, dispositions, financings, and joint ventures, including a number of joint ventures with cross-border investors, including investors from the Middle East. And just to sort of echo what Ehab and Lauren said, with respect to the Sharia compliance, the principles are as they outlined, and what we typically do is work with the Sharia advisory board or the other Sharia advisors with the client to determine, what how they like to structure their transactions and how they view compliance with Sharia principles. Because as Ehab and Lauren mentioned, different investors have different takes on some of the requirements and have different requirements with respect to structuring their transactions. So Islamic finance is a method of financing and a banking system that complies with Sharia law. It's important to understand the basics of Islamic finance because over the last years, the Islamic finance industry has been growing, and there have been a number of investors and lenders here in the United States that are becoming more comfortable with these principles and are engaging in transactions. And we're seeing, with respect to some of our real estate investment transactions, lenders from the largest lenders on Wall Street to smaller regional banks. The Islamic finance is based on many prohibitions and restrictions, which are legal in the countries where Islamic financial institutions operate. So it's important to be aware of these principles. As Lauren mentioned, paying or charging interest is considered exploitative practice and is not permitted. And so you have to structure transactions so that interest is not payable. You also have to ensure that the businesses that are engaged in prohibited activities such as alcohol production or gambling or selling, for example, pork, that the tenants in the buildings where the Sharia compliant investors are investing, don't engage in those sort of principles.
And if I actually follow up quickly on this, I know you want to continue on that part.
No, that's okay.
Because you mentioned, the part where there's, no interest based and making sure that there's no, as they call it, maybe haram transactions happening by either pork or alcohol. We all know money is fungible. So how is that kind of like separation between potentially an operation that includes part that have transactions that requires interest is separated from the ones that doing Sharia compliance?
So there are a couple of ways that those principles are addressed and that we accomplish those results. There are two structures, and we can get into the details later. But one is a sort of master lease structure, and what is done is the transaction is converted from, or not converted, but the transaction is structured so that the tenants are paying, that there's a subtenant that's paying rent to the entity that needs Sharia compliance, and so they're not paying interest, but they're paying rent. And then with respect to the businesses that are prohibited, what we've done in transactions is basically create sort of two silos. And for the tenants, the ultimate tenants that are engaged in businesses that are permitted, we have them pay rent to an entity that is owned by the investor that requires Sharia compliance. And for those that are engaged in businesses that are not permitted at all, for example, a bank or some of the ones that you mentioned, Mohammed, you create a separate silo with an investor that does not require Sharia compliance.
Thank you. This is interesting, and then I'm gonna kind of like move on into, because you mentioned the structuring. How is it structured? What is the models that it's followed within Sharia law compliant transactions are followed? Is there like specific parts or structure that we can, as investors, or if a company is transacting with someone that requires Sharia compliance, they can follow? Is there big terms or specific structures? Do you mind maybe diving in a little bit on the structuring and how these things work?
Lauren, you want to start the discussion on the master lease structure there?
Yeah, so there are two primary structures, but what we have seen to be the most common structure is to set up an ijara or a master lease structure. So again, this is, and we've mentioned this several times, but it is so vital in what we do with real estate finance. So Sharia law prohibits the payment or receipt of interest. What the ijara lease does is it creates an Islamic financing structure that establishes a lessor-lessee relationship, as Gerald noted, rather than a creditor-debtor relationship. So it creates a structure that abides by Sharia principles. So here's an example of how a typical real estate transaction would look if it involved an ijara master lease structure. So the real estate is owned, but would be owned by an entity that is wholly owned by a third-party paid service provider that is unrelated to the party that needs to comply with Sharia law principles. These service providers are companies who exist, among other things, just to be nominees in a real estate ownership structure where there's a mortgage loan where you need Sharia compliance. So the property owner is the borrower under the mortgage loan made by a third-party lender, and is also the lessor under a master lease. The actual borrower who is responsible for paying interest to the lender is not owned by the Sharia-compliant investor. The real estate is leased by the property owner to the master lessee under a master lease. And then, as Gerald alluded before, the master lessee subleases space in the property to third-party tenants who pay rent to the master lessee, generating the necessary income to operate the property. The master lessee is typically owned indirectly by the investor that needs Sharia compliant structuring, often through a joint venture with other investors who may or may not require Sharia compliance. The master lease is designed so that the timing and the amount of the payments due under the master lease, so the rent comes in from the subtenants and then the rent is paid from the master lessee to the master lessor, it all matches the timing and amount of payments due under the third-party loan from the lender. The master lease is often a really lengthy document, and it also contains representations, covenants, and default provisions that correspond directly to the representations, covenants, and other provisions under the lender's loan agreement. So the property owner can honor its obligations under the mortgage loan documents. But because the master lease structure is that property owner borrower's only source of income through the rent, you have to make sure that the documents all work in tandem. There aren't any conflicts between the loan documents with the third-party lender and the master lease. There's a lot of mirroring of these documents. One other point to note on the Ijara lease structure is that it does resemble a conventional lease in many ways, but there are some important distinctions. Sharia law dictates that an owner of an asset has certain responsibilities that cannot be delegated to its lessee in the body of the lease agreement, including performing major or structural maintenance, obtaining property insurance, or paying real estate taxes. So in some situations, the property owner, again, this is the entity that is the borrower under the mortgage loan, is owned by the nominee company that's unrelated to the Sharia compliant investor. The property owner then engages the master lessee, who is subleasing the property to the tenants and is ultimately owned by the Sharia compliant investor. The property owner engages the master lessee in a separate supplemental agreement to provide certain services, such as conducting maintenance, performing structural repairs, major maintenance, performing structural repairs and alterations, and obtaining property insurance. So all of these documents work together to make sure that the borrower can get the loan, the borrower can pay interest, the property can generate income, and this arrangement all works in conjunction with Sharia law requirements for the upper tier investors.
And that's the structure that remains in place for so long as the loan is in place. And then in order to structure the transaction such that the investor, has the benefit of the economics on an exit transaction, there are put and call arrangements that are put in place. And there's a call option from the owner to the lessee, whereby the owner grants the lessee an option to purchase the property for a price equal to the amount of the outstanding third-party loan. The call is also exercisable, if there's a loss resulting from a condemnation or a payment in full of, repayment of the loan or payment in full of the rent under the master lease. And then the flip side is that there's a put option from the lessee to the owner, that the owner can require the lessee to purchase the property for those same amounts in the event of default or a total loss or condemnation or the final payment of the rent, so that at the end of the transaction, the property ends up in the ownership of the investor that requires Sharia compliance, and then it can sell the transaction, exit, and reap the benefits of the appreciation in value. And then there are also other ancillary documents for the transaction that we typically see. There's the supplemental agreement that Lauren mentioned with respect to the master lessee delegating some of its obligations under the lease. There's a tax matters agreement between the owner and the lessee, providing that all parties will treat the transaction as a financing transaction for tax purposes. And then there's an option agreement that gives the joint venture the right to, sell all the interest in the owner to the joint venture. It's sort of a mirror or corollary to the put and call option agreements that we mentioned. And then there are collateral assignments of the contracts, licenses, permits, the underlying leases, they're all assigned to the master lessee, and then the master lessee assigns them to the owner, so that the owner can assign them to the as collateral under the loan agreement, as you would typically see in a conventional, for lack of a better word, conventional mortgage financing.
Yeah, and then just to recap what Gerald said earlier, if you do have a tenant base of the property, it's, say you have a bank in the property, and so that bank, even though it's a creditworthy tenant, is not going to have a Sharia compliant business. So you take the structure we just described and you basically create a duplicate structure. Again, so the Sharia compliant businesses are going to ultimately be part of the master lease structure that's owned by the Sharia compliant investor. And then the non-Sharia compliant businesses are going to be housed in a master lease structure with no Sharia compliant investors. But for most intents and purposes, those structures are similar or the same. The master leases are near each other. They all still work under the loan documents. And that's how you would cope with tenants in a multi-tenant property that may not be Sharia compliant.
And Lauren, thank you for actually mentioning that last part. I was going to ask a little bit more on that part. Like, I don't know if I'm sure it's not called hybrid, which is like, dual structure, could be hybrid. Can you elaborate a little bit more about that similar hybrid structures? How is these non-compliant and compliant maintain kind of like solid silos? Is it kind of created in a silo in a way that these are non-compliant, don't feed into the compliant one?
Yeah, it's really about I think it's about the flow of income. Really, the structure is all designed to actually, it operates kind of in the background. It's like a program that's running. But when it comes to actually operating the property, the idea is that the property managers and the asset managers can run this property without really having to delve into the leases. It's designed to operate like a regular property, but you do have to keep the income streams separated so that the Sharia compliant investors are not reaping the income from non-Sharia compliant businesses. So you have these two structures where the non-compliant businesses pay rent to the non-Sharia master lessor. And so that's how you keep it separate. It's basically the flow of income from the property is going to you need to keep those separate in order to keep the Sharia compliant investors compliant on their end. And I don't know, Gerald, if you have any other thoughts about that question or how we keep it separate or any other gloss on it, but I think it's really about keeping the income by.
Sure. No, that's right. I mean, effectively what you do is divide the building. So, let's say that you conclude if there are 10 leases in the building, but there are two, one is, a bar or liquor store and another is a bank. What you do is you structure it so that those two tenants pay rent to and sublease the space from, the master lessee that is not required to be Sharia compliant, and that the investor that needs Sharia compliant treatment has no economic interest in that lessor of that space. So as you say, you divide the income, you divide the building, and you ensure that the investor that needs the Sharia compliance, has no interest in the income that is produced by the non-compliant ultimate tenants.
Great. I mean, if I kind of tell something out of this, is that if you want to do these, you always should have a lawyer, because there's a lot of terms and a lot of things, that relates into it, specifically with the structuring, even if it's not hybrid, there's a lot of things that goes into it. And I'm, from my little knowledge when it comes to Islamic financing, I'm sure we're going to there's other terms beside ijara that feeds into it. Murabaha is Murabaha in Arabic. It's a big term. There's other as well structured financial transactions. Beyond Ijara, do you mind highlighting what other structures that you see? What is Murabaha? Murabaha, in my knowledge, Murabaha means profits. That's the exact translation of it. How is this structured? What is it different? How is it differentiated from a regular commercial bank that does regular interest-based financing? Do you mind maybe give us a little bit details on that? Because we hear the word Murabaha a lot.
Sure. Happy to discuss that for a bit. And one of the things that is interesting about the transactions that use the Murabaha structure is that it is sort of transparent to the investor, because to the other investor, the joint venture partner, if you will, because they're not party to that transaction. The way that it's often structured is that the investor who needs Sharia compliance engages in transactions, often purchase and sale of, say, commodities that are permitted to be owned and purchased and owned and sold, in compliance with Sharia requirements, pursuant to a transaction that, involves a spot purchase on day one and a repayment of the purchase price over time, with a built-in markup that has a profit element but is not characterized as interest. And so what you can do is, on day one, the investor engages in that transaction, uses the proceeds to invest in the properties, and then repays to the affiliate of the investor over time the proceeds from the Murabaha contract, which has the result of which results in the proceeds being Sharia compliant, because they're coming from the commodities transaction, the permitted commodities transaction, as distinct from a transaction, with a non-compliant tenant or non-compliant interest arrangement. And it's done sort of separately from the joint venture transaction, and the joint venture partner is not party to those transactions. So we see those transactions engaged in where there's a Middle Eastern investor who needs to be Sharia compliant, investing in the United States with, say, a joint venture, an operating partner here in the United States, that is not party to that transaction, and really has no interest in being party to that element of the transaction.
How is the within the Murabaha, the profits added to the sale? How is it restructured? In regular conventional banking, we have refinancing, right? And things get changed. Like after 5 years, interest rate, if you're a conventional bank, drops, you go in and refinance, or as an investor, if it's a lot of money, they do a lot of these transactions. Does that apply as well to Murabaha, or is it, if I do the deal today, that's it? I'm going to have to end up paying the money in 10 years, the same amount. Is there a new way to actually, it's not an interest rate, but maybe reduce the amounts based on the market?
They can be adjusted over time. And what we have seen structure the transactions where the element, or the profit element, if you will, is baked into the contract at the beginning of the transaction at sort of a specified return, which is often tied to the expected, say, return or preferred return, or our expected IRR in the transaction itself. And then there are undertakings by both the seller and the purchaser of the commodities, where if the profit is more or less, the payments are adjusted to sort of reflect that economics. And then you can adjust it, if the underlying transaction is refinanced over time, you can enter into new transactions. But there are undertakings, excess profits, deficient profits are sort of made up, if you will. They pay to make up the difference.
That's really interesting. And again, I think the more we go through this webinar, the more we realize how, it's critical for entities or firms to work with the experts when it comes to Sharia compliance and structuring deals, because there's many things that goes into it, and I'm sure we can tap a little bit more on the structure. But Ehab, I want to go a little bit, ask you a question. Since at the beginning you mentioned, the Middle East transactions are expanding. A lot of foreign companies, or in this case, it's American companies, engaging in the market. That growth that you mentioned on Islamic financing, utilization, do you feel there's a specific reason that's driving more Sharia compliant transactions? And do you see a lot of the foreign entities try to comply with them, or do you usually see them preferring conventional banking from your expertise in the Middle East?
Mohammed, like one of the things that you have seen, because you are also one of the sovereign wealth fund experts in the community, that the surpluses that has happened to many of the Middle Eastern entities, being investment banks, being family offices, being sovereign wealth funds, has generated opportunities to deploy. And as you know, one of the most attractive markets for the Middle Eastern money is the US. Because of the solid fundamentals and the reliable returns and the rule of law and so on and so forth. And therefore, like the Islamic finance in general is a very interesting and a very dynamic, welcoming platform that designs products that accommodate the needs of the money coming from the Middle East. So we have seen an increase in that. And as you know, you and me, being from Middle Eastern origins, our culture believes very much in real estate, and therefore this is a primary go-to for many of the families or many of the individual high net worth individuals from the Middle East, in addition, of course, to investment banks, because of the all the benefits of investing in real estate and so on. So we have seen this volume going on in that direction. And then we have seen also a very strong movement from the US businesses to the Middle East. Many of them would like to incorporate in Qatar, would like to incorporate in the UAE, would like to incorporate in Saudi Arabia. And their partners, in some cases, are very fine to do the businesses in conventional manners, and businesses are going fine in that regard. And in many other cases, the partners, being individuals or investment banks or other educational or like healthcare entities, would like to have it in compliance with the Sharia principles. And here the tendency is to incorporate the entities or to form the fund or to do the real estate transaction in a manner that is compliant with the Sharia principles. So it is like this, the business is welcoming the investments both ways. The US entities are very fine to accommodate the requirements of their partners in the Middle East, or their partners in the Middle East when they come here in the US. And the investors are happy to deploy their investments in the best manner that achieves the return of investment that they are looking for. And they will be very comfortable to know that the cultural manner and the morale that they are looking to achieve is established in the transactions that they are making in the US or with the US entities when they come to their homes in the Middle East.
Thank you, and I agree with you. You mentioned the sovereign wealth funds and then expansion, and we see that's happening a lot in many cases. I mentioned that at the beginning, and I kind of bring it back again a little bit. Indeed, it's not necessarily all Middle Eastern countries require Sharia compliance in all their projects, but sometimes it is. And if you're not ready, that's my understanding, sometimes in understanding it, then you might miss an opportunity that could come and requires compliance. So not everyone wants it, but why leave a piece of that pie on the table if you can comply with it? And my understanding is that many international lending banks or organizations are switching in a way to create, well, I don't want to say they switch to themselves, but creating entities within that have that part of lending, because they don't want to leave something on the table and always be ready to offer something to their client. Is that accurate to say?
Yes, I think that that's right. There are a number of financial institutions that are engaging in these transactions, including, as I mentioned, some of the largest names on Wall Street, but as well, we've been asked whether regional banks are also comfortable with these structures, and we are seeing the smaller regional banks lending into transactions involving Sharia compliant structure as well. So I think that there's a growing acceptance and engagement by financial institutions.
And I would add too, we try to, as I mentioned, we try to create this structure so it's more or less seamless for the lender. I mean, the lender's got to be okay with it in a general sense, but they're getting paid their interest. Their borrower is the master tenant, so they have to they review the master lease, they make sure it mirrors the loan documents. But on a day-to-day basis, the property operates like any property does, and this structure doesn't really have a great impact. And I think that's the benefit to the lenders. I mean, there are the other structures as we mentioned, but this once the lender is familiar with it, and hopefully they have some lawyers who are also familiar with the structure and they can talk them through it. It's not, it becomes a matter of getting the paperwork correct and getting the documents revised correctly. And as Gerald said, we've seen different kinds of lenders accept this structure. We've also seen, for example, a senior loan, and we had a mezz loan in the structure of a master lease structure. So we had a mezzanine borrower for the purpose of the property owner getting additional funds in order to do renovations. So that was a component. We saw a CMBS loan. So this master lease structure is also capable of being securitized and sold on the CMBS market. So you're seeing it works well, and lenders are getting more comfortable with it. And I agree, they're not wanting to leave potential clients out in the dark and not, reap the benefits of engaging in those relationships.
I would just add that the lenders are comfortable from sort of both the underwriting and cash flow and repayment perspective, but also, and this is very important to them, from sort of a remedies perspective, because they know that the transaction is structured, with all of the collateral assignments, et cetera, that if things turn south, they will be able to foreclose and exercise remedies and obtain the properties, just as they would in a conventional structure.
Thank you for that. It's interesting how these things are structured in a way, and I assume you mentioned specific structuring when it comes to insurance. I assume that applies as well on taxes, and it applies for potential changes in tax codes. Do you feel like the tax codes, specifically since we're in the United States, complicate these kind of agreements, or makes it, because there's city taxes, there's state tax, federal tax, property tax. In many ways, it's different from one state to another in the United States. So does that structure change every time an investor is looking to do something in a different state in the United States, or is it more there is that big skeleton that we all see and it's clear, and then we just modify based on the transaction itself?
So you do have to look at local taxes in each state and each jurisdiction you're in. That is sort of a real estate law principle that applies to any transaction and doesn't necessarily apply especially to these types of transactions, but you do have to be aware of it. A number of states have mortgage recording taxes. And so you have to make sure you can mitigate that structure in a way that works with your master lease structure, if possible. It depends on the jurisdiction, but there are ways to mitigate that. But you do need to take that into consideration when you're making the loan in the first place. And in terms of the payment of property taxes, I believe that would be paid by the master lessor, paid based on the income that's ultimately coming through the master lease structure. You could also, you oftentimes have a scenario where you need to escrow taxes with the lender. The lender will then pay them directly. That's a negotiable point, but sometimes you do see that, especially I think believe we had that in the CMBS financing because the lenders they want to feel like they have additional protection to make sure they're paying the most fundamental costs of the property and not be concerned about liens. So you do need to think about that, but those specific jurisdiction, property, real estate related items are things you'll have to deal with in every transaction, and something that we, as real estate finance lawyers are on the lookout for, whether there's a Sharia structure or not.
Thank you. And I mean, that makes total sense. Now, I want to just mention, if for our audience, if you have any questions, please send them in the chat, and I'll be glad to read as much to get our guests to answer today. So if you have any questions, please post them in the chat so we can get to see them. I still haven't seen any question so far, so I guess it's getting clear, unless if I'm missing something here, but we'll see how it developed. Now, since yet we haven't got anything from the audience, we talked a little bit about the investments in here, and we highlighted some part where these entities, foreign entities, let's say American companies, are doing business in the Middle East and many countries that might require Sharia compliance or to be compliant with Sharia law. Is there, and I'm not sure if Ehab, from your practicing there, this applies not just to real estate investment, right? It applies to potentially trade deals or general engagements in the market. Maybe in the Middle East, there's sometimes engaging in any big project, there's bid bonds and performance bonds, and requiring some financing to go through or trade to go through. And these laws, these Sharia law matters apply to them as well. So I know we're highlighting a lot of the real estate investment today, but it is true that it applies to many other aspects of the, let's say, life cycle of any trade or engagements in many of the countries that might require that. Is that correct?
Absolutely, absolutely. And it depends on the practice, Mohammed. And as I told you, the models that we will design, depending on the transaction, is flexible, provided that we consider all the elements that we have mentioned, that we have to make sure that we comply with in any Sharia-related transaction. We have done this in relation to the fund formations, for instance. And this is a product that is like up and coming, and we see it a lot because of the strong fundraising movement that is happening in the US from investors from the Middle East, and also for some fund investment formed in the Middle East to start deploying investments in the Middle East, specifically focusing, as you can imagine from your experience, on healthcare and biotech because of the needs of the region there to new developments and so on and so forth. Gerald, did you want to add something that you have seen in other types of transactions as well?
Well, like I said, we focus on the, sort of the real estate investments, but we are seeing investments in mixed use properties, properties that have office components, retail components, and, recently did a transaction out in the Midwest where the buildings were primarily leased by a state agency. So it's a variety of investment types.
Yeah, and for the completeness, Mohammed, before we leave this, you kindly alluded to the different terms that we covered in this session in relation to murabaha and ijara that are very common in the market. But as I'm telling you, there are other products that has been developed recently, not recently, throughout the years. It's well-established practice, such as, for instance, mudaraba, which is a profit and loss sharing partnership in which one party will invest capitals and the other party will invest in skill and working hours, and the parties share profits in according with a pre-agreed ratio. There is another term also that we will hear a lot in other types of transactions apart from real estate, like musharaka, which is a profit and loss sharing joint venture in which all the parties involved contribute capital and similarly share profits and loss on a pro-rate basis. But like they are not as common as we have seen in relation to Ijara and the Murabaha, in addition to other types of structures that scholars and investment entities has been developing ongoingly. And it is a very interesting thing for us all the time to be able to look at the matter on a case-by-case basis. And if it doesn't fit in any of the well-established structures and products that are available in the market, we will be able to figure out a solution that will always be helpful to our clients and comforting to the other non-Sharia compliant entity in the transaction to make sure that the business will keep going on.
Thank you. And actually, couple questions that came through here. There's a question about sukuk, and I don't know if that's something that can be mentioned. Let me just go through a couple of them and then let you decide on who wants to take what from these questions. And there's another question about is the leasing option requires 20% also for commercial real estate as a down payment? I'm not sure if that has any differentiation. And then the final question in this part is that beside the halal and haram part of it, do you see any other benefits business-wise from utilization of Sharia compliant transactions? These are audience questions in here. So I'm not sure who wants to take the sukuk one at the beginning.
Yeah, so sukuk is again one of the products that our capital market teams has been doing for many of the financial institutions, and it was very well established. It has its own criteria and requirements to meet, and we are very happy to provide you guys, or maybe like if you prefer, Mohammed, to have another session assigned to discussing sukuk and the ways that they are structured as a treasury product in compliance with Sharia. Happy to do that. But yeah, it is again another very well established area of the business world that like the Islamic investors and the Sharia compliant investor have found comfort in dealing with it as a treasury product. Yeah.
And I agree with that. And I would say to the person that asked the question is that if you would like to reach out to us here at the USQBC, and we'll direct you in the right way to maybe get more information specifically when it comes to that. Or if you're actually trying to engage in that transaction, maybe the law firm can as well help you when it comes to that understanding. Now, on the other part of the question, I know that one was not maybe as clear it is when it comes to does it require 20% down payment also in commercial real estate when it comes to the leasing option? I'm not sure. I'm not understanding the question. Maybe if someone has asked that question to clarify, what do they mean by the 20% down payment on that part? And then the other one is the benefits beyond business benefits. Beyond that, it's halal and haram. Is there any part of it to utilize Sharia compliant master agreements or ijara rather than going with a conventional?
Well, I think the primary benefit is that for the investors who require Sharia compliance, it's a sine qua non. You have to do it, or else they can't engage in the transaction. So the primary benefit is that it's a pool of capital that otherwise wouldn't be accessible to you. Not unlike in other circumstances, you see foreign investors investing in the United States that, for tax reasons, for example, have to invest through a REIT. It's just an element of the transaction. And if you want to do the transaction with that investor, you're going to have to own the property for a REIT, and an exit will be a sale of the REIT. So I kind of think of it as similar considerations, because otherwise you would not be able to do the transaction with that investor.
Thank you. And
I think that question in relation to the down payment is a simple one. Does it really change, like, let's say that we are doing a standard Sharia like real estate transaction? I think the ratio of the down payment compared to the amount of the loan like is not really relevant to the type of the Sharia. It will be always something that is required depending on the risk criteria of the deal for the lending bank.
I think that's right. I mean, the lender will have sort of its maximum loan to value, which may be, significantly less than 80%. In this market, it may be 50% or some other number. And the fact that it's a Sharia compliant transaction, that doesn't change because they're doing the underwriting.
Yeah.
Whatever the credit committee is going to approve.
And the other thing, Mohammed, that for the kind attendee who asked about the other business benefits for the Sharia deals, apart from, of course, respecting the lines between what is halal or what is haram, is the material principle in the Sharia transactions in general. Which is the material finality of the transaction. As we said, in Sharia law, every transaction needs to be related to an actual and real underlying economic transaction. So the possibility of building a lot of derivatives and creating lots of bubbles that we have seen affecting some economies when the underlying asset is not standing or not returning the expected returns is, I think, less in the Sharia transactional framework, whereby the underlying has to be solid and existing. That doesn't allow to lots of derivatives away from that. And to be honest, like the scholars, we are not scholars, we are practitioners, we do deals, but there are lots of scholars who have written a lot about the benefits for the international economy and for the business community on relying in the Sharia principles and Sharia transactions. And we are happy again to provide such resources to the attendees who have sent you the question if he or she would like to have more resources on that.
Of course, no, thank you. I appreciate that, and I know we're running out of time, and it's an interesting conversation, and I believe we only covered maybe one and a half major element of the Sharia compliance laws in here, and I know that there's more to talk about, and Ehab, thanks for offering more time at some point in doing and discussing this. But there's also question of how is it different when you deal with different Sharia compliant requirements, meaning when you mentioned the Sharia boards or the mufti for each specific country when it comes to the actual okay or not okay when it comes to these transactions. And I know it's in many cases it could be different from one country to another based on their boards or the Sharia boards that they're dealing with, could be more strict or more conservative when it comes to these laws. Some of them, they're a little bit more, I think, maybe easygoing in some of these requirements. I understand that there's different structures when it comes to how these boards look at things, and it depends on the country that they're coming from or where your investor is coming from. So again, I think it's critical having attorneys and lawyers that understand that structure is very important. Entities that they want to engage, they don't have, as we said it maybe at the beginning, you don't have to unless if it's a requirement from whoever you're working with, either internationally or in the United States. So the market offer different options and different alternatives. You might want to be ready, you might want to understand it from now to be part of any transaction in the future that might be requiring Sharia compliance or Sharia law built into their transactions or their investments. I really can't say much, but thank you so much for taking the time. I know, you know, attorneys always they always keep an eye on the time, and so we don't want to take more of your time. We appreciate it, and we appreciate sharing that knowledge. And I'm sure DLA is ready to offer, or DLA Piper ready to offer advices to any entity or requires to do Sharia compliant transactions. Do you have any last words before we close the webinar today? Lauren, Ehab, or Gerald?
No, to be honest, we are very thankful for you, Mohammed, and for the team for arranging this. We are very thankful for the attendees who spared some of their valuable time to attend and to listen to us. And we will be always there. We believe very much in what we are doing in relation to the Middle East and sovereign wealth fund practices. We are like investing a lot in every possible way to be a strategic partner for our trusted clients and counterparties and the amazing business partners like you, Mohammed, and the Business Council. So thank you very much. And on behalf of my colleagues also, I think we are always grateful to work with you and to cooperate with you in any possible way.
Of course, I really appreciate it. And I might not have noted this at the beginning, but the webinar is recorded, and the recording will be available for people to watch at some point if they need more information and learn more. And we look forward to continue these conversations on many aspects that your firm engage with, and specifically with the Middle East. We see this is an important region for a lot of American companies from the USQBC perspective. There's a lot of investments flowing there. There's a lot of investments from there coming in here. So there's many ways we can engage and continue these conversations, and we'll have more of these webinars to highlight it. So thank you for tuning in. Thanks again for your time, our great guest speakers and our attorneys. If you have any other questions, please reach out to USQBC. We'll pass on as many questions as we can to the firm. If you wanted to do any transactions, we'll be happy to connect you to the DLA Piper from our side. And we look forward to see more of our audience on our future webinars. Again, thank you so much for your time, our guest speakers, and I hopefully wish you a good week.